Hello, everybody, and welcome back to the 23rd edition of the Digital Gold Institute Quarterly Report. As you see, I'm not alone today, and we have a special guest, Blake Heimann. Hi, Blake.
Hi, Ferdinando. How are you?
Fine. What about you?
All good, all good. Thanks for having me on.
Yeah, Blake is a senior associate at WisdomTree, and I have invited him because I've been able to witness a couple of his presentation, and I've been really impressed by his full understanding of the crypto world, which is not that common, if you allow me, in the TradFi world. So WisdomTree, as probably most people following us already know, is one of the issuers of ETF in the US, but an historical player also in Europe with ATC, ATP on Bitcoin and crypto. So unfortunately, you will have to bear with me first when I go with the usual report, and then Blake will be taking the stage. And 23rd quarterly report. It's almost 6 years, so quite a lot of time. Thank you to everybody following us. We have strived all these years to try to, in a way, to summarize with our quarterly report what is relevant for any C-level to understand about the crypto world. 6 years ago, most C-level in the traditional finance world were not really paying that much attention to Bitcoin crypto. Today, things have changed, but still there is a lot to be, in a way, catched up. And we have been doing that through consultancy and research and training and code development. Yes, we also do that. And Michele has been assisting me in the recent years, and he's been presenting this report last week at Milan FinTech Summit. But today it's my turn to introduce the report and then to leave the floor to Blake. So we, as usual, touch on the markets, ecosystem, regulation, and technology. So markets, so let's start from the performances because, well, at the end, everybody's interested about that. So let's face it. And the fact that Bitcoin just had a quarter of plus 5%, unimpressive, or somebody even say boring by Bitcoin standard. I mean, Bitcoin is kind of spoiled us to double-digit performances. And as a matter of fact, the market capitalization didn't grow in the last quarter because 5% is almost negligible. But Bitcoin still dominates trading volumes because it's just the 60% of the traded volume. Stablecoin excluded, followed by Ether, and in a way, each quarter has its own champion. This quarter has been Doge mostly. 6-month phase of post-bull run consolidation, because this quarter plus 5% is after minus 12% in the previous quarter. So basically, we have gone down from the 69% of the first quarter this year to plus 55% year to date. But two relatively less relevant quarters after two very strong quarters. And this is one of the slides I've been borrowing from the Blake presentation, so I will be short on this. Bitcoin is pretty much every year the top performer. The year that is not a top performer, it's a top loser. Quite huge drawdown, but overall the increase in the market price of Bitcoin, as you can see, if you plot it on a log scale, has been a straight line, so an exponential growth. And do not forget that the first quarter this year, we have seen the most recent all-time high. Year to date, the performance is plus 55%, and the last 12 months is a remarkable plus 144%. Another slide that I'm borrowing from Blake's presentation, so he will go deeper on this later on, is that there is this year there has been the periodic 4-year Bitcoin halving that, although quantitatively irrelevant these days because the amount of Bitcoin being issued is already almost irrelevant, and so halving make it just more irrelevant. Anyway, this has always been a bullish event. At least it has been so far in the previous cycle, and then maybe we can discuss with Blake and even our audience about if this will be the case, or if this has already been the case in this quarter, in this cycle, sorry, in this 4-year cycle. Anyway, if everybody looks at this cycle, well, this might become a kind of fulfilling prophecy. Last but not least, we know that the next few months, both in the US and in Europe, we'll see some central bank rate cuts, and this historically favor Bitcoin and crypto. Volatility of Bitcoin has been increasing in the last quarter, but as usual, as we try to convey quarter after quarter, I think that the most loyal follower might be bored by this evidence, but I mean, every quarter consolidate the evidence that Bitcoin volatility is nothing special. I mean, it's comparable to the Tesla volatility or Nvidia or Netflix or Amazon or Apple. Almost, I mean, as you could expect, the top performers from the last 10 years, they share similar volatility, because let's remember that performance and returns are always the compensation of risks. When it comes to correlation, all relevant to obtain a diversified portfolio, we see that all cryptos are strongly correlated, but crypto, Bitcoin namely, is decorrelated from equity index, from crude oil, from treasury notes, as you would expect from a different, completely new asset class. Especially if you confront Bitcoin with Ether, the second, the most likely peer in the crypto space, the correlation is relevant. But if you are among those considering Bitcoin a North American tech stock, well, think further, because the correlation with NASDAQ is not that high at all. And if you, like me, consider Bitcoin the digital equivalent of gold, well, the market has not agreed yet. But this makes this turns out to make the correlation with gold almost negligible. So Bitcoin provide a lot of decorrelation in a diversified portfolio. Markets this quarter have been going institutional. Also, this can be proved, of course, it is proved by the launch of the ETFs in January, Bitcoin, and in July, this next quarter, Ether, but also by the traded volumes in terms of futures contracts at Chicago Mercantile Exchange. As you can see, every quarter this year has been an order of magnitude bigger than the previous quarter. Ether is growing up too. And the same can be said about the options traded at Chicago Mercantile Exchange. ETFs, well, Bitcoin, we have been already discussing this in the previous quarter, has been an incredible success, basically breaking all previous records about ETF launches. The Ethereum ETF, there were expectations that could follow in the same steps. It did not, at least not so far. On the same scale, the Ether ETFs are negligible. And even more than that, while the net flow in Bitcoin ETF has been positive, and I talk about net outflows because there has been, net inflows, because there has been a significant outflows from the Grayscale Trust, Bitcoin Trust. Well, instead, the cumulative flows for the Ether ETF are negative for $500 million. So that's one of the reasons why this quarter has been probably kind of unimpressive. But European financial institutions are finally moving. I mean, we are used to see US names, but this quarter we have seen BNP Paribas, Commerzbank, Cassis, Deutsche Bank, and DZ Bank all entering or announcing to enter the custody market. And we had many banks active in Italy, also launching trading for retail clients or proprietary trading. I mean, Intesa Sanpaolo, the major Italian bank, as a proprietary trading desk. Ecosystem. Well, in Italy, the crypto market is expanding. As of June 2024, OAM, the Organismo Agenti e Mediatori, which is collecting data from all the crypto asset service provider, attested that 1.3 million Italians owns digital asset. And this is an increase year on year of 51%. And in terms of cryptocurrency held, the amount has grown from 1.2 billion to over 2.2 billion, so 80%, 90% increase, of course, mostly due to the appreciation of Bitcoin and other crypto. But even if you look on the other side of the Atlantic, I think that the most relevant thing going on in the last quarter and the next quarter, the final quarter of this year, is the battleground in the race for the White House. I mean, we have learned that Trump is a strong pro-Bitcoin supporter. He went as far as saying that the US government will launch a strategic accumulation plan. Kamala Harris is more conservative, she's following the tradition of the Democratic administration so far. But even from a more conservative point of view for the Democratic administration, if you pardon my pun, it's like she had to do some kind of opening to blockchain and artificial intelligence and crypto too. So probably the relevant thing about the US election is that they might have a very strong positive impact if Trump will be the winner. But even in the case of Harris being the winner, this should not be a negative impact because things will not get worse. Things will stay the same as for the Biden administration or improve in a way. Whatever your political bias, I mean, these are just facts, not that we are supporting one of the two candidates. Banks, even central banks, are in some way investing in Bitcoin. Yes, because if there are Morgan Stanley and Goldman Sachs directly buying Bitcoin ETFs, there is even the central banks of Switzerland and Norway buying MicroStrategy. And they have to buy MicroStrategy because MicroStrategy is now in the most relevant equity indexes, North American equity indexes. And so to replicate those indexes, even central banks are basically getting exposure to Bitcoin. Of course, not directly, but indirectly through MicroStrategy. But this looks like a Trojan horse, and which has been pretty much effective at having central banks investing in Bitcoin. And so to try to wrap it up in a way, regulation. Well, regulation, we already discussed about the under-impressive performances of the Ether ETFs anyway. Even if they're not being a success so far, it is impressive that they have been approved in less than 6 months. It took 10 years for the Bitcoin ETF to be approved, and when the SEC, the Security and Exchange Commission, approved Bitcoin, they put black on white not to expect other cryptocurrency ETFs. Instead, just 6 months later, we have Ether ETFs. This proves that, in a way, the regulators are opening up a lot. And if this is surely happening in the US, it's also happening in Europe. This year, and in Italy, the last 30th of June, there has been the enforcement Europe-wise, the European Union, at the European Union level, of MiCAR, Marketing Crypto Asset Regulation, which ensure greater transparency and security for investor and industry participants, because it is a regulation that has to be applied to all crypto asset service providers. So a crypto asset service provider like CheckSig I mean, we were not regulated formally, at least formally speaking, until June, and now we are regulated by both Consob and Bank of Italy. So regulated by our central bank and the Italian equivalent of the Security Exchange Commission. Technology, not that much to talk about beyond maybe the Polygon upgrade from Matic to Pol, but this is minor news. Ethereum, after moving to proof of stake, hasn't actually introduced anything really disruptive. And Bitcoin, well, Bitcoin, we know that it moves forward at a very conservative pace. So the main technology news of the quarter has been basically the new all-time high of the hash rate. As I've been saying since the last halving, the profitability of the mining ecosystem was so high that even halving the reward, the revenues, as basically didn't stop the growth of the mining hash rate at all. So takeaways, the performance of the last quarter has been unimpressive, but volatility has increased, nothing to be right home about in both cases. The correlation is still strong. The growing institutional and retail adoption at the Italian level, at the European level, at the international level is being remarkable. And there are signs that can point to a positive outlook for price growth. The potential halving, self-fulfilling prophecy, the MiCA regulation, the favorable rate cuts, and the US political support. Technical innovation this quarter, basically a consolidation phase with record hash rate. And so the next updates for our quarterly report will be at the annual Crypto Asset Lab conference that the Digital Gold Institute organized with the European Commission at the University of Milano Bicocca. Of course, I invite all of you to attend the conference in Milan on the 6th and 17th of January next year. But this is time to leave the floor to Blake Heimann. I already told that Blake is one of the crypto analysts I appreciate the most. I think his understanding of crypto ecosystem is strong and very rare in traditional finance, I would say. So I'm very glad to have Blake on the recent evolution of crypto market. Blake, the floor is yours, and maybe you want to share your own slide.
I do. All right. I am pulling them up right now so you can see. And thanks for having me, and thanks for letting me share a couple ideas here. And it's great to have alignment as you spoke through your slides, covering a lot of the same concepts and similar things that we're paying attention to. So that's validating to know that the traditional financial people are looking at the same things that those that are more crypto native are also looking at. So that's good to know. As I share screen here, I just want to double check that you guys aren't seeing double, because I want to make sure I can still look at Ferdinando here in case he has any nice comments to jump in. But for today, I wanted to spend some time talking about this market evolution, as well as some of the market dynamics that are changing really right underneath our feet, and try to give a light or put a little bit of a limelight on what is lying ahead. Ferdinando alluded to a lot of these key points, but I'm hoping to maybe add a little bit more color to some of those points. And then Ferdinando, feel free to jump in and add any thoughts and commentary as we go through here. So the first thing here to discuss is the market evolution. And this is really the evolution of institutions coming into this space. The US ETFs at the start of the year were really a big stepping point. Really as just I'll say a key benchmark for the rest of the globe and even Europe, to just kind of note that, hey, one of the largest markets in financial, or one of the largest markets in terms of financial markets on the planet, is now approving Bitcoin exchange traded products, and now Ethereum exchange traded products, and likely beyond in the future, to all investors in the US, the retail and the professional investors. Very quickly, we saw the London Stock Exchange and the UK follow. So the FCA followed the SEC's steps to make those approvals. And we even saw Hong Kong, Australia, Thailand also have approvals. And right now, there are some evolutions in South Korea to have approvals for regulated exchange-traded products on digital assets to be approved, starting with Bitcoin. So this institutional wave of having regulated products available has really rapidly evolved in the right direction to now make most developed markets have access to these exposures in a regulated vehicle. So that's a very big development for this year. We've seen a lot of asset flows into these products, which demonstrates the trust and the I'll say the professional investor appetite. I won't sit here and tell you that every dollar of these 18 plus billion now that has landed in crypto exchange traded products across the globe through year to date is going to be directed from professional managers. But the stepping stones are clear that the professional managers are allocating. If we take a look at the exchange traded funds in the U.S., particularly at the SEC filings from the 13Fs, which show the holdings of different institutional and professional money managers in the U.S. Each quarter that they have to report, we would start to see some notable names on the list. And this is taken as of June 30th. I believe the actual latest for the end of the previous quarter are released. Today would be the 14th, so maybe even tomorrow. So we don't have the latest data quite yet, but we'll be looking to see how those allocations look and to see who's holding the Bitcoin ETFs in the US. But most notably, I'll just kind of highlight a couple of the things here. And the first one that I think is definitely worth talking about is the State of Wisconsin Investment Board, which is a pension fund in the US that here is showing 26 basis points, but they have estimated around 130 or so million, maybe it's 160 million in AUM sitting in Bitcoin ETF. So somewhere around the 40 to 50 basis points of overall exposure of their current fund in Bitcoin exchange traded funds. So that's one example. We also see some of the examples that Ferdinando was speaking about earlier in terms of the advisory market and Morgan Stanley and Goldman Sachs having allocations here. And this is really driven on the back of the fact that, particularly with Morgan Stanley, has a very large investment advisory arm. Home office is what the terminology that we use in the US, the home office that manages all the approved products for the local advisors in, say, my parents' hometown that have the local investment advisor and financial planner that they are a client of managing their retirement portfolio, now is having actual approved Bitcoin ETFs on that list to then have that discussion with individuals like my parents about their retirement goals and understanding, does Bitcoin fit that investment profile and how much should we allocate? And we're starting to see those allocations, and you can see 180 plus million already landing there within those remits. And then you'll also see InvestNet Asset Management here as well, which InvestNet is a very popular advisory tool as well that has now also opened the doors and seen a lot of those advisors allocate from their retirement clients as well. So a lot in the advisory space and the retirement solutions, which is a huge market in the US. I believe the estimate is like 35 trillion when you include 401ks. So this is a very big development, very big market that has opened up. And we're really just starting to see, I'll say drops in the actual pool, given the fact that we've seen this 18 billion in AUM move into the space, but there is a large expanse of this 35 trillion that we could maybe imagine having a 1% allocation or something from that major pool. Also on this list, you'll see Millennium hedge funds. You'll see some names like Renaissance Technologies. You'll see Tudor Investment Group. So a lot of macro, a lot of in hedge funds, and some of the best investors out there also having at least a small amount allocated to or to Bitcoin. Millennium being a large allocator here, obviously given their AUM, as well as the fact that taking some non-directional exposures in the space could also be something quite interesting that we've seen available with some of the futures and the spot pricing that's taking place. But nonetheless, we are on this trend towards greater institutional adoption. We're starting to see some of it here on these tables. So keep a lookout as we get the latest 13F filings maybe tomorrow or in the coming days. In terms of this wave of institutional adoption, so I end up speaking to a lot of institutional investors across the European markets. I was just, in traveling in Monaco last week, the week before in Switzerland. I was in Milan a couple weeks before that. So I've been kind of all over and kind of getting a feel for how investors are looking at this asset class. And some of the discussions we're having, because it's really evolved quite a bit from education oriented to being very focused on implementation and understanding how to think about this in a portfolio sense, because people are no longer ignoring this asset class, and it is becoming a part of the general multi-asset portfolio, especially when you're thinking of it in a neutral like market allocation, which is being shown here on this slide. So if you take the overall market cap of essentially all the liquid assets that are available on exchanges across the globe, you'll see that generally you can kind of get close to that 60-40 mark-ish with your equities and fixed income when you start to take the list of investment grade bonds, high yield, et cetera, and then your EMs developed, et cetera, in terms of equities, and then your alternatives also having a little slice here. But the interesting thing is you will see that when you take that entire pie, that is roughly a little over 200 trillion in total market cap. But then digital assets, the entire market with Bitcoin being the majority of that at this stage, is sitting right around or right above 2 trillion, I believe 2.4 trillion or so as of today. And that amounts to roughly 1.2 or just above 1% allocation in this market weighted portfolio. So this is one of the realizations that really makes people aware that, hey, this asset class is now large enough to be a part of the portfolio in a neutral view. So to actually exclude it warrants an actual active decision to be underweight, to say, I actually view that this is going away, so I need to be underweight, which means I would have less than this 1.2% allocation versus, say, an overweight, where if you're quite bullish, you're sitting above this 1.2% allocation. So it's quite profound to think about it that way, particularly when you look at emerging market small cap equities being right around the 3 trillion mark. So you talk about a couple, good weeks of Bitcoin and reaching new all-time highs. You're looking at reaching that 3 trillion mark, which is in alignment with EM small caps. So it's a very it's very important to realize how much this has grown over the last 15 or so years.
And if I can corroborate that, there is a paper from 2021 from the CFA Research Institute Foundation, so the Foundation for Research of Certified Financial Analysts, suggesting since 2021 an allocation of 2.5%. So even if just that will be received as a suggestion, that will mean like the crypto market growing a factor of 2. So,
exactly. Very big. Yeah. So, and some of the other things that are kind of coming on the back of this is, okay, the understanding of the market being a certain size. Now, how does that actually play with the rest of the assets in my portfolio? And Ferdinando, you shared some slides on this showing that it is quite decorrelated amongst some of the other assets in the portfolio. But so a little bit of repeat here, but I think one of the important takeaways from this is that a lot of times portfolio managers allocate to commodities, for example, as a diversifier to their portfolio. And the interesting thing here is obviously Bitcoin showing up here on the top row is essentially almost much more diversified across all assets, even comparing to commodities. So you're looking at essentially what we say is diversifying your diversifier by adding a diversified asset to your diversifiers. So it's a really quite a nice play to add this completely uncorrelated asset to the portfolio mix, because this really just, I mean, given the volatility of the asset class, which we'll go through later, and you showed on previous slides, is it has been going down a bit, but it's still extremely high. And for traditional investors that are managing fixed income portfolios, equity portfolios, you name it, the volatility number is very scary. And it could actually mean, them beating their benchmark or underperforming their benchmark, which means it could mean a good bonus or a bad bonus at the end of the year. So this is where understanding the small allocations in the decorrelated nature and some of the benefits of diversifying the entire portfolio with this asset can be quite beneficial. And just to demonstrate some of that volatility, I think this is one of the charts that Ferdinando, you were referring to earlier around the market cyclicality. And you can see here that, in 7 of the last 10 years, Bitcoin was a top performing asset. In 3 of those last 10 years, it was the bottom. So it was either at the very top or at the very bottom. And the interesting thing is it also represents some of the cyclicality that is inherent with this market. You'll see that some of the worst years in performance were taking place in between the actual halvings. So Ferdinando, you mentioned the halvings before, and at this stage, having a lot less impact given the amount of Bitcoin that's being issued. But historically, that was a much more meaningful amount, and also historically, we have seen whether there's also psychological factors coming into play. But this cyclicality results in essentially massive drawdowns every 4 years that were staggered, 2 years off of that, the halvings that took place, and then in the 3 years, in the years surrounding and the years of the halving, having extremely strong performance and outperforming all other asset classes. And that's the key thing to take away from this slide is it's still early and it is still very much a growth asset. And it still has this very strong potential to be a strong outperformer amongst all asset classes. So even in 2023, you'll see Bitcoin at the top of the list at 150%. Fernando, I think you showed the chart saying up 55% year to date. I think that's outperforming all other asset classes this year so far. So even, what feels like a very rocky year for Bitcoin and, challenging for the people that are tracking it day in and day out, but still extremely strong compared to all other asset classes that somebody would be investing from a multi-asset, portfolio and a professional institutional investor perspective. And that's where the conversation leads into if we start to look at back testing and see what does it actually look like for investors to take a small allocation and allocate away from, say, their equities or their fixed income in a traditional 60-40 and allocate a small percent to digital assets. And you'll find that because it's quite decorrelated, the actual, I'll say, trade-off between the additional risk that's added to the portfolio versus that additional benefit of asymmetric upside that you get results in, based on the historical analysis, higher Sharpe ratio. So you add roughly, if I show the 1% Bitcoin portfolio here on the second row for volatility, you're adding 7 basis points of overall volatility with a trade-off of 60 plus basis points of annualized return. So that's like a very historical analysis and a very simplistic approach towards looking at this. But these are the conversations that I would say take the institutional investors an additional step from, okay, I understand the investment case. I like it. I like the asset. It's extremely volatile for my, say, my pension fund. So I'm not sure we're ready to make the allocation. But then you start to throw these quantitative metrics together. And then you start to combine that with more advanced methods for portfolio construction, such as looking at, including, say, a Black-Litterman model, which is essentially taking forecasted expectations for future returns, using Markowitz mean variance to optimize the portfolio subject to those assumptions. And you can essentially back out a couple different allocations based on different scenarios. And most of the time, if you're putting together a very basic scenario for Bitcoin with the assumption saying, it doesn't necessarily need to grow at the rate that it has in the past, but as long as it outperforms equities by a few percentage points, it lands in the portfolio because of how decorrelated it is. And so there's a lot of ways to really slice this from a portfolio construction perspective, and each firm has their own approach. Some of it's very focused on just the alternative sleeve. And they might even be replacing hedge funds, because when you look at it, it's like they can allocate to digital assets or allocate to Bitcoin, be up 50% year to date, and have a fee of, I mean, for a very low fee of, say, less than 50 basis points, 35 basis points or so, versus paying 2 and 20 for a hedge fund and having, say, liquidity issues. So these are liquidity constraints. So these are a lot of the trade-offs and conversations that are leading to the allocations. And, you know, when we kind of wrap all this stuff together and talk with the institutional investors, the reason you're seeing these 1 to 5, 1 to 5% allocations is because in the most conservative portfolios from these analyses, you'll see a 1% allocation generally be the quantitative outcome. And a little bit more aggressive, you'll see this 3 to 5% type of allocation, which is why, Ferdinando, what you said with CFA saying at 2.5%, that seems very balanced when I hear that.
So we could even say that the current global market allocation is pretty much conservative at the current status.
Exactly. There's so much more room to grow here in terms of adoption. And I mean, anytime I speak to somebody and they're feeling like they missed it, I'm like, you know, the amount of people that I hear people say that, and then I'm like, it still is such an early stage. And then it's funny because I can't remember, there was somebody else that said, is such an excellent quote. And I completely forgot who mentioned it. It might have been, I'll give the shout out if I can think of. I think it was somebody definitely in the Italian cohort of crypto experts, and so I'm trying to give the best shout out I can without revealing who they are. They said, you buy Bitcoin at the price that you deserve, and I was like, that was such a profound statement. Particularly in this environment and this overall adoption stage. So I just have to drop that note in here because I loved it. All right, so to continue on and kind of summarize this first topic, which was really around this market evolution and institutions jumping into the space. And Ferdinando showed a couple slides on, you know, futures activity and options as well, which has actually helped to dampen down some of the volatility as some of these players move in and try to hedge their portfolios accordingly. And we did see, you know, the Bitcoin options just be launched in the US on some of the US Bitcoin ETFs. So there is, you know, there's not only, you know, this institutional adoption from allocations and the approval of the ETFs, but there's also, you know, new derivatives being developed and becoming accessible, and obviously people, you know, taking advantage and using them accordingly, which was shown by all the volume that Ferdinando showed at the very beginning. So this area, this asset class and market has matured a lot over the last 15 years. It's over that 2 billion mark, and it's quite sizable. It's approaching the EM small cap size of market, so it is something that really can't be ignored. And even the 1% allocation that we talked about is extremely conservative, and we're starting to see those and see investors make those allocations. And you know, obviously, we're showing and finding that it's quite a good fit for multi-asset portfolios to include Bitcoin and digital assets more broadly, because they do give you know, quite unique characteristics, particularly when you look at the trade-offs between the volatility and the asymmetric upside potential, and obviously just the underlying technology that is enabling this stuff to take off in terms of overall adoption and use cases. So a very exciting time to be in digital assets. Now, to kind of shift gears towards what's happening and what's actually driving prices, and maybe kind of step a little bit away from the, I'll say, more conceptual side of things. Some of this will still be conceptual because, as we all know, there's an unlimited number of variables to take into account when evaluating what could happen in the future. But hopefully this kind of explains what has been happening and shares a little bit of insight as to how we look at things going forward at WisdomTree over the next couple months. So, Ferdinando, you addressed the Bitcoin halving. So I always like to discuss this because it is it depends on what circles you're operating in, but can sometimes be a bit contentious because some people subscribe to the Bitcoin halving thesis a lot, whether they lean into the psychological aspects of it in terms of, particularly with just the cyclicality and this trend of people talking about it on the news media and all of the other, I'll say, intangible things that make it exciting versus just the, you know, the physical, I shouldn't say physical, but the actual what's actually taking place here, which is just the reduction of the block reward over time, which reduces the issuance, lowers the overall inflation rate, and theoretically, should make the market a bit more tighter. Now, as time has gone on, the reason Ferdinando says quantitatively irrelevant as time goes on is because, as you see, the block reward gets cut in half. Obviously, it amounts to less and less new supply, which means less and less over time is just being reduced. So this is going to have less of an impact over time just inherently by, this chart, this table on the right-hand side. Now, the interesting thing that I always kind of caveat this with is, we acknowledge the fact that there's this psychological aspect and this technical indicator type of aspect of it, and even somewhat of a macro type of understanding of this, because if you kind of think about it analogously to the traditional financial world, where we're paying attention to what the Bank of England's doing, the ECB is doing, the Federal Reserve in terms of managing monetary policy, Bitcoin has a very codified monetary policy, which is what we're looking at here, which is the overall reduction in issuance over time. So it would make sense conceptually that this would have an impact, but it has been less over time because the actual amount. But the caveat with all of this is that there has been a significant amount of Bitcoin that is actually sitting in wallets that have been relatively dormant, or essentially not selling or not moving their actual Bitcoin on exchange to sell. It's been sitting as a long-term store of value for those people holding Bitcoin. So if that is, I believe last time I checked, 68% or so of the market hasn't actually moved their Bitcoin within the last year, that would mean that, the actual fraction here is going to be a little bit higher when you're looking at, say, the liquid supply. So I would say I don't necessarily have the expectations that we will see a price recovery uptrend by 2-3x, or even, another additional 50 to 100% from where we're at. But I do want to acknowledge that this does have a small impact, whether it be partially psychologically, but also just because a very subtle reduction in issuance, and that does have an impact, particularly on the miners, is something that we saw. So we want to acknowledge this as a variable, but maybe not the most important variable in the equation of how Bitcoin gets priced. So, Ferdinando, do you have anything to add in here?
Well, I mean, as you said, if you look at the percentage mined so far, being at 97, 98, 99, 94% is not that much relevant. But, it's like with the Olympics. Even if you do not pay attention to sports, every 4 years, your attention is drawn to sports and you are interested about who are the faster athletes and so on and so forth. So most people, a lot of players, are just every 4 years being reminded about Bitcoin and say, oh, wow, it's still alive? Yes, it is alive and kicking. And so that's powerful. It might be quantitatively less relevant, but it's a proof of resilience in a way, and a moment where everybody's paying attention to how much has been growing. So it's all relevant, especially because we should never underestimate how much behavioral the market can be. And so,
yeah, it's a very good point. Yep. So yeah, one of the reasons that I'll speak to, kind of attributing why some of the Bitcoin halving pricing, was probably even further dampened from what we saw, is really the impacts of. So to start the year, we saw about 18 billion in net inflows move into Bitcoin, particularly through the ETFs buying these Bitcoin, right? So with that 18 billion being, acquired on the markets, you actually had come July, the reverse of that to about the number of 8 billion US dollars equivalent of Bitcoin, which was in the Mt. Gox and the German government wallet balances. So, sorry, German government wallets. So essentially, US government and German government had acquired Bitcoin from a collapsed exchange, and essentially they owe this Bitcoin back to all the creditors that had lost their money. So in a very loosely analogous FTX type of situation back in 2013. Now, finally, all of those, so those assets that were confiscated during this collapse are now being redistributed back to the creditors. And this is what we saw in July and August, is the actual redisbursement of this. So this was essentially a flood of an additional 8 billion more Bitcoin in terms of US dollars going back onto the market, leading to the price, to the price to fall to around 55,000 at certain points. So we essentially saw the price almost double. So going from, say, 35,000 to roughly 70,000 at the first few months of the year, due to the overall new ETFs buying up a lot of Bitcoin. Then you start to see a little less than half of that in terms of US dollar value being sold off and or being redistributed throughout this time period. Obviously, not all of it was sold off, but it led to kind of hitting a short-term price bottom of around 55,000. So it was actually oversold, particularly because of this. So I think some very smart analysts did some on-chain analytics here to kind of figure out what might be a nice would be a good a maximum expected bottom here. But the fact that it kind of landed in between, where we saw the prices from the start of the year versus the end of the year from roughly half of the amount of overall Bitcoin acquired during this time period, made it quite a lot of sense, I would say, in terms of the price action. But so what the nice thing is the price rebounded quite quickly, particularly because this was essentially pricing in all of this Bitcoin that was being redistributed to be sold. And obviously not all of it was sold. So that was something that led to a lot of volatility in July and August. Very quickly, as we've kind of rolled through July and August, everybody, kind of came back from summer holidays. Then the U.S. politics became quite very much of in the focal points. This here is just showing U.S. government income versus the actual, which is the teal. So the total federal receipts is tax payments versus the overall debt, all as a percentage of GDP. And the key thing here is that we are living in a time period where debt to GDP continues to grow, and there is no it does not seem that there is any actionable items that are being taken to help solve this problem. So this really leans into the thesis for Bitcoin as an alternative, as governments continue to borrow, continue to devalue fiat currencies. And, we're lucky enough in the first world to trust our central governments to manage things effectively, that we don't have runaway inflation or any of these very extreme scenarios or any type of serious levels of corruption that would make us lose faith. But in extreme scenarios, this is where Bitcoin really plays a nice role. So as politics come into the limelight, and as we see, particularly U.S. Presidential nominees start to speak around all of their different policies, one of the interesting things has been that even in the debates, the budget deficit wasn't even addressed. Now, policy obviously impacts the budget deficit, but there seems to be no aim to actually solve this problem. And that just leans into the long-term case for adopting Bitcoin as this, I'll say, alternative currency, this alternative reserve currency and long-term store of value that can be a very nice complement to all the other assets that traditional investors hold. In terms of looking at some of I was actually running probably about a week ago, and had the headphones die, and was sitting there thinking about Bitcoin of all things as I'm running, rather thinking about Bitcoin or when do I quit this jog. And one of the things I was thinking about was as there are plenty of firms out there operating as a neobank or like an online banking system, one of the ways that analysts tend to evaluate the growth and adoption of these neobanks is around funded accounts. Like, essentially, do we have people funding accounts and using the platform, and and that tends to give us an indication of how important this platform is in terms of growth, in terms of revenue in the future. Now, Bitcoin is very commodity-like nature, so it's a very different approach. But one of the important things to acknowledge is that the overall adoption is continuing to grow. I believe the estimates for total crypto users across the globe is actually somewhere near 1 billion. I believe that's taken from something that Raoul Paul has posted, as well as a few other crypto asset managers and whatnot that are out there. So that's across all cryptocurrencies and probably all centralized centralized use cases as well as decentralized use cases. What we're showing here with the black line is the non-zero addresses on the Bitcoin network versus the actual price at the log scale. And obviously, we've seen the price increase over the long run, but the overall growth of non-zero accounts, it's not just people creating a wallet and not having any actual monetary value being sent to it, but it is actually people having funded wallets. And the interesting thing is this is going beyond the Coinbase world where everybody has their retail account with Coinbase. This is actually funding a separate wallet because your Coinbase and retail wallets are generally commingled in a way. Like obviously you have your separate account and everything's protected. But at the end of the day, if I send myself Bitcoin from my Coinbase account to a separate Bitcoin wallet, I will have a different Coinbase wallet every time. Whereas my Bitcoin wallet that I send to, I know is uniquely mine. I'm managing the private keys. But the important takeaway is that we're seeing this growth continue to go upward. And we're also seeing from historical price highs, where in 2021, we saw the price at 70,000. We have a significantly cheaper valuation in terms of these overall funded accounts. So if people are looking at this asset saying, oh, I should have bought at 70,000 at the start of the year, or I should not have bought at 70,000 at the start of the year, or I should wait for the price to go down or whatever. Like the key thing here is that this asset class is still growing in terms of adoption. So the important thing is to actually have that allocation more so than timing things perfectly. In the same way, if you're looking at Amazon back in, say, the year 2000, if you're looking at the price earnings ratio, it's going to be extreme, right? And nobody would ever invest based on these type of metrics. But the important thing is that you do allocate. So I'm not going to say that this is the perfect way to evaluate Bitcoin and from a fundamental sense, but it is one of those reassuring things to know that, hey, I know we're sitting near all-time highs from 2021, but we have seen a significant amount of growth in these non-funded wallets. And you can start to look at daily active users and all these other metrics as well to evaluate. But we have seen this continued long-term growth of adoption demonstrated here. One of the things, Ferdinando, that you alluded to earlier was speaking about the rate environment going forward. And I think looking historically, so it's a very similar chart in terms of looking at federal funds rate and the total crypto market cap, or just the valuation of Bitcoin as being a key part of that. One of the things that I think is worth highlighting is that historically, yes, we've seen, as there's more liquidity in the system, that it tends to benefit digital assets. We have seen digital assets somewhat buck that trend a bit, particularly as we've had this higher inflation environment that's been rampant across the globe. So that's, I would say, overpowered, and as well as the growth side of things have overpowered, I'll say, the negative impact of this tighter monetary policy across the globe. But as we start to see policy loosen, we could see, investors shift out the risk spectrum and gravitate to Bitcoin and other digital assets like Ethereum and even altcoins. And the important thing to acknowledge as we go forward is that, there could be some political volatility and other impacts, impacting, the market. So I don't want to just say that this is the only variable that matters, but it is an important one, and it is shifting to be more bullish, I would say, digital assets, and particularly for altcoins, because if you take the long-term performance over the last 3 years and just do a quick beta calculation versus Bitcoin, kind of proxying, say, the market, you'll see that the actual beta to Bitcoin for daily returns tends to be higher for altcoins, meaning that when Bitcoin's performing well, altcoins tend to perform better. So, and vice versa. If Bitcoin's not doing well, altcoins tend to do worse. Now, we have had a little bit of a interesting evolution of this year to date, particularly from this wave of institutional adoption that has really benefited Bitcoin more than, say, the rest of the assets in the ecosystem. So we have seen some of these numbers shift around a bit. But one of the things that did emerge post the U.S. Federal Reserve rate cut that took place in September was the week following, and even just the hours following, you started to see digital assets outperform a lot of other assets. So that was the risk on nature of things. And then notably, you did see altcoins outperform Bitcoin and outperform Bitcoin very much in line with this concept of the high beta to Bitcoin. So if we do end up seeing continued rate cuts to, say, enhance the overall liquidity profile of the environment, some of this money moving away from money market funds and into higher risk assets, as well as you still maintain, say, a soft landing that doesn't make people worried about the global economy, or if we start, especially if we also start to see global geopolitics start to simmer down a little bit, that could frame up a very beautiful, nice position for altcoins going forward, particularly on the back of this being one of the key factors of liquidity and lower rates, and this high beta to the digital assets broader market for these assets. So we got a hint of this post the Fed Reserve cut, but this is something we'll definitely be watching throughout the fourth quarter here. Ferdinando, that's a lot of topics there. I don't know if I've been going on for a while. I've got a couple other things on technology, but I'm happy if you have any other thoughts, feel free to interject.
I will love to ask you a question, because I mean, so far both you and we have been presenting quite a lot of positive indicators and optimistic and bullish indicators. But you have a lot of exposure to many institutional investors. What is the major objection they have about crypto and Bitcoin adoption? What is the main thing that is still maybe getting them on the conservative side, as far as you are concerned, exposed in the relation with them?
A lot of it is, I would say, I really hate saying this, but I'm going to say it: career risk. It is. It is a lot of internal. The people are running very successful businesses for a long time in financial services. They have been very successful in doing asset allocating and investing across all traditional asset classes, and they have strong client bases and good client relationships. They're excellent businesses. It is a bit of a risk to think you're now going to enter into this space that is there's plenty of regulation, but you also think that it's also so brand new that now you have additional compliance people that need to be on board and understand this entire space. You have to have additional investment people that understand this to the right extent to be able to have the right interpretation of how to, say, value or maybe not value is the right word, but attribute value to this, to explain it and get clients to be fully on board. But the interesting thing is they're getting a lot of positive feedback from clients. So it's actually been more client driven than, say, from the CIO side of the house, where they're like somebody on the investment team says we have to invest. It's a lot of times the actual, PMs and whatnot will actually have personal allocations, but they can't invest professionally because within the actual CIO part of the house, they haven't approved it yet, but there's slowly making progress here because they're getting client demand. And also they are seeing a lot of the stuff that we've talked about with the quantitative metrics. They understand the investment case. Sometimes they're already invested personally. So it is just, being willing to, take that leap of faith to know that all of these things are, pointing in alignment, versus what they don't want, which is the extreme case in the wrong direction, is allocate at 70,000. Next year, it's a bear market. Even if they allocate, say, 1%, next year, bear market down 65%. I mean, you don't want to be underperforming your benchmark and have a client leave because you timed it wrong. And I think that is a lot of where some of this is coming from, is this fear. So we're getting over that, but it's been a work in progress, but we are making significant progress, which is why we've seen a lot of the allocations and that we've seen so far year to date.
Another question I have for you is that, and I love this career risk. I mean, we were having lunch today with my team, and we didn't spoke about that before, but my team was exactly asking what is stopping people, and I was saying not too much upside for traditional finance managerial people to move into uncharted territories. But you also briefly touched on drawdown risk. I mean, in the past, we have seen extreme drawdown with Bitcoin, 83%, 75%, 70%. But recently, we have seen much lower drawdown. And I am under the impression that with a larger market and increasing size of trades and institutional investors entering into the market, we might not see in the future the large drawdown we've seen in the past. I mean, still significant by traditional finance because it's like minus 40% or 50% is among us in traditional finance, but I don't think we will see extreme drawdown like more than 70% in the past. Do you agree with that or have a different opinion?
I definitely agree with that. I would tie that very closely to kind of what you showed about volatility and seeing some of that decrease and fluctuate over time. And I would say that, as we see the market mature, less drawdowns. Now, that is still caveating the fact that if you have an extreme scenario that's like near impossible, like I'm thinking of a Satoshi wallet moving and something crazy happening where people like completely question everything. I could see that, leading to, a 75% drawdown or something like that in tune with what we've seen in the past. But I essentially assign that close to zero probability. So I always try to think of these things in probabilities, but definitely as time goes on and as the market matures, I would suspect that drawdowns would be much less than we've seen historically.
Also, we have two different paradigms of top manager changing their minds. I mean, we have seen we've seen Diamond, the JP Morgan CEO, being on a very adversarial position toward Bitcoin, and then JP Morgan opening up facilities for his clients. And when he was pressed by journalist, he told the journalist, well, our clients ask for Bitcoin, our clients are adults, and we help them to invest in the most safe way. A different approach has been by Larry Fink, the BlackRock CEO. I mean, his CIO has been advocating for Bitcoin for years, and the CEO has been opposing that. And then he changed, but he's changed his mind for real. Like, now he spoke on television about Bitcoin being digital gold. So there is a pragmatic approach by the leaders, the one I mean that can change strategic choices for their firms. But there are two different kind of behavior, like the one that in a way give up but do not concede. It's not like admitting that he was wrong, and the ones instead completely changing their mind. How do you see this psychological different attitude that play with the current adoption?
So what you just described there with Jamie Dimon and Larry Fink is essentially very analogous to kind of what I was alluding to with the career risk commentary. Is that we definitely see the Jamie Dimon types where CIO and the internal house view based off of some key leadership is against it and not worth the risk. Then you also have others that were essentially flipped. So I think the good news for people that are already involved in this space is that both of those are essentially predominantly what we see across the board. And maybe there's a natural, I'll say, natural bias towards the people that are actually willing to meet with us, because you have to be open-minded to meet and discuss this stuff anyways. But essentially, almost everybody we speak to that hasn't already allocated and already adopted this asset class falls within those buckets, which is quite optimistic in my view, because it means that things are changing in the right direction. Because at the end of the day, if you're looking for open doors to access to allow people to make investment decisions and allow for equitable investment opportunities and financial opportunities, then this is the trajectory to make it accessible, make people allowed to make their own decisions versus completely closing the doors because of somebody that Big Brother decides not to adopt something. But it's so I look at it as positive, even if there's some ups and downs, particularly with some of the commentary that's used when they're speaking.
Yeah. I mean, we just crossed the 1 hour mark, so this conversation is going long. But I would love to chat with you for a couple hours more. I don't think this is appropriate for the YouTube audience. Anyway, let's try to wrap up with two final questions that I asked to you, and you decide which one or how much you want to go deep on both of them. First observation, I mean, there is a huge interest into, in some way, alternative assets. And I think I've heard from you that the only alternative investment that is liquid enough to be included in a portfolio, whatever kind of investment portfolio, is actually Bitcoin. Bitcoin does trades, I guess, something like 20 times the traded volume of Apple each and every day. So it's very much a very liquid one. And I mean, a discussion on crypto will not be complete without touching on stable coins. We see the stable coins increasingly growing in terms of relevance and market capitalization. What do you think? What do you see for the futures of stablecoins? So I will leave to you these last two questions.
Yeah, so let me take the latter one on stablecoins first, because that actually refers to a slide I have here, and I'll very quickly run through this, which is showing the overall amount of tokenized assets on the Ethereum blockchain as well as some others. So stablecoins are an example of tokenized assets. This actually is excluding stablecoins. This is only looking at equities and fixed income commodities, etc. So now reaching, approaching 4 billion in assets of tokenized traditional assets on chain, excluding stablecoins. Now, stablecoins are an interesting evolution because the purpose they served for crypto investors has really been a place of stability in times of trouble. So it really had an amazing product market fit, particularly amongst all the DeFi users and any other crypto entrepreneurs that are building in the ecosystem. Because they, when there is a market sell-off, when something happens, it could be a macro event, you name it, to have all of their assets tied into the value of all these tokens and then see all of them, the prices fall down because they're obviously traditional risk assets and people are looking for liquidity to allocate to a safe haven. Like, they needed something safe. So what do? They allocate to stable coins, which now has actually become a $200 billion market cap. And I was actually speaking to a colleague of mine that was saying that Tether, which is a firm of 100 and something employees, essentially makes similar, if not more, revenue than Goldman Sachs, and it's a stablecoin issuer. So, like, huge opportunity that they met and solved for, and there's obviously many others that are out there. But this other space of tokenized traditional assets is now leaning into that. So I think this is going to become a very important piece, because what it is the bridge between this blockchain focused decentralized world like that lives on, say, Ethereum, being a much more technology platform, versus, say, Bitcoin, which is this long-term store of value that's commodity like in nature. So you could imagine Bitcoin being this pristine piece of, say, collateral like gold. And then you see Ethereum being the blockchain rails, or even these other alternatives to Ethereum, being the key blockchain rails that are facilitating a lot of the financial transactions and financial activity that is currently taking place on Excel spreadsheets and centralized databases and this really inefficient infrastructure, if you will. So seeing these traditional assets move onto the blockchain to start to garner some of those benefits, I think, is a super profound thing, and also validating for, what this technology can do. And you're seeing major players. WisdomTree is one of them that's focused in this area as well. And then the first question, Fernando, remind me the first question again.
It's very high liquidity alternative investment, much more liquid than any other alternative investment option.
Yes, so that speaks to, I don't know if I include a slide here for this, but it speaks to actually a little bit about this risk contribution method of our portfolio construction analysis. And one of the things that's interesting is, so based on that approach, it's essentially like just inverse volatility weighting of your alternative sleeve. So essentially Bitcoin or digital assets being extremely high volatility compared to your other allocations you might have within that alternative sleeve. Maybe it's commodities, maybe it's hedge funds, maybe it's private equity, whatever. But they tend to have this alternative sleeve that they're allocating according to the overall volatility. But Bitcoin is mark to market every day, every hour, every minute. Whereas your private equity, your venture capital, Sometimes your hedge funds, et cetera, are not marking to market, that often. They're marking to market, maybe at best once a week or once a month, a quarter. So, and you also don't have so you're naturally going to have, likely at least, because the mark to market sometimes is defined by, a party that may not be perfectly, may not have the complete separation of interests, in a way, is the best way I would put it. So it's not as objective as everybody hopes. So you have that aspect of it, but then you also have the liquidity aspect of it. A lot of these other alternatives have lockup periods that require you, if you're going to redeem out of, say, a hedge fund, you can only redeem X percentage of the fund over so long of a period with a certain heads up, like a certain notification period. So you don't actually have the liquidity that you have in digital assets, which is why, in the large cap space, it's an excellent alternative asset to include in this alternative sleeve, because you have the additional liquidity, the mark to market every day. I know it is a bit more volatile than maybe others, but it's kind of all perceptions, because you're not getting a mark to market every day on the other assets, and who knows what that could actually be priced at day in and day out. So and then if you go further down the market cap spectrum beyond Bitcoin, Ethereum, and say the top market caps tokens, you start to enter this liquid venture space, where essentially you can be engaged with the founders in these with these tokens and these ecosystems, these projects, via Telegram, personal direct connections, etc. Kind of also even do development for the project. So you can take a very almost hands-on approach towards your investments, but also knowing that the token that you're working with is or that you might be investing in the project you're working on or working with, could be trading every day in and day out on exchange. So you get the key takeaway is you get so much additional liquidity while still getting this nice alternatives type of exposure versus what else is in there. And the returns have been quite amazing, which is why we're seeing a lot of people actually say, we're going to cut out our hedge fund exposure and we're just going to replace it with digital assets. So it's been quite an interesting evolution.
Okay. So thank you very much, Blake. And I suggest to everybody who has been enjoying this presentation to follow you and WisdomTree on your research. Of course, the product of WisdomTree benefits from people like Blake, putting into a lot of work. And I'm glad to have a pioneer company with such a brilliant quant researcher as a guest speaker for our 23rd DGI quarterly report. If you like this video, please, of course, click like, click subscribe, or whatever on whatever social you are following us. I suggest that you follow Blake and WisdomTree. And of course, see you down the road. And Blake, my usual way of closing things up is to wish to everybody to have a good week and a good Bitcoin too.
Excellent. Okay. Love it.
All okay. Right. So bye-bye, everybody. See you, everybody, down the road.
Bye. Thanks. Bye.